Okay, hey everybody, welcome to the Investors Conference Call. A couple of rules and a brief statement. First of all, if you're watching this for the first time on YouTube and you just ran across us, I'll tell you probably need to go to the website and check all of that stuff out first, or half of everything that we're going to be talking about today will probably make no sense. At the investingtherightway.com website, you'll find a detailed class page that includes free videos in the appropriate order that they need to be in. Also, we've added a additional web page just yesterday, actually, that has all of the previous investors conference calls archived in that one section in a playlist, with the most recent conference call being at the top. You'll find a resource tab with a bunch of websites and things that we use, including $3,000 worth of free downloadable documents, so you can do this as a business without having to pay a business attorney to set it up for you. So we've saved you some money. All of that stuff is free at the website, and everything that we're going to be discussing about today is, of course, going to be free as well. I have on the phone with me Mr. Tanner. Tanner, you won't see him on the screen. He is at his house, and he is connected to us with his phone, probably with a Bluetooth headset. Mr. Tanner, how you doing, sir?
Doing excellent, Jimmy.
Excellent.
Doing wonderful. I'm excited about doing this conference call and talking about what's going on in the market.
I wanted to address some of the concerns or questions or theories that some of the listeners have. So we're going to open that up here in a minute. But one of the things that I want to talk about, because we have said often, is we think we're at the end of a bull market. And, you know, we keep continuing to be in this bull market. And I know some questions that many listeners will have is, what do you think is going to be the catalyst for actually tipping us over into the bull market? I have a theory on that, but Tanner, what do you think is going to be the final straw that breaks this camel's back and we actually tip over into a bear market for a while?
When the Fed starts raising interest rates.
That's exactly what I was going to say.
Yeah. Yeah, when they start raising interest rates, people will start pulling their money out of equities and throwing them into bonds, which are considered safer. And even though it's only a 3% rate of return, a lot of people are satisfied with that. But it's a guaranteed rate of return. So, but that's really what we're looking for. We're looking for 3% on the 20-year Treasury, 3% or higher. And when that happens, that's probably the catalyst, the last straw that will lead us into a bear market.
Now, do you think we have to actually engage in some interest rate hikes, or do you think it could be something as simple as because this bull has been so long, because we're teetering on the edge, and I'm going to give some evidence of that here in just a second. Do you think the only thing that the Fed may need to do is Janet Yellen step up and say, well, you know, the recovery's going really good. It looks like that we may, here in this near future, have to start raising interest rates. So not an actual rate hike, but just the Fed saying we're fixing to do that. And before you answer that question, I will tell everybody, because I'm hearing a bunch of noise in the background from microphones, please mute your microphone and or telephone, however you're connecting with us, so we don't get that bleed over. So answer that question.
Yeah,
Ron.
you're exactly right. All it really will take is Janet Yellen coming forward and saying, hey, by the way, instead of it being a year-long time horizon for raising interest rates, we're going to start doing it now. So, or we're going to start doing it in 3 months. And that's really just, it's kind of like having an earnings report with forward guidance. That's all the Fed does. They come out essentially with an earnings report for the entire nation. And then they say, okay, our forward guidance looks like, well, right now they're saying we're going to discontinue tapering completely, possibly by October. Okay, well, they'll do the same thing with interest rates, and the market will begin to react just at the hint that we are nearing the time when the interest rates are going to start rising. So,
in fact, even if that is not the moment that tips us over into bear, if they provide forward guidance that says we may have to start raising interest rates sooner than we expected or sooner, if the word sooner is used, you can pretty much bet that that's going to be a bad day for the market, period. That's a day that when she says that, you want to buy a VIX call immediately.
Yep, that would be the position I would take because it's going to, the move, when it occurs, it's going to be a drastic move, and it'll be swift. And so what you want to do is you want to put yourself in a position, even if it's maybe a little longer term, especially then like the double day play that we've been done. So you may go a week out and 2 weeks out in order to buy that VIX. And that's at least what my plan is. I'm going to be buying into that.
Yeah, to reiterate, we can't advise people what they should do, but that's what I'm going to do. Yeah. Let's talk about some evidence that's pointing in that direction. For those that are doing this via the computer, I have a chart pulled up on my screen, and it's TLT. But what I want you to pull up on your screen, and I'm going to switch, is the S&P 500. And if you are on Telechart 2000, that symbol is GSPC, Golf Sierra Papa Charlie. And I'm going to show you something to you. So this is the S&P 500 chart, and each one of these candles, these red or blue or green candles, red or green candles, is a day in the making of the S&P 500. And as you can see, we've been in pretty much a trend of upward. And on the screen, we've got the beginning of 2013 all the way to now. And we've been in just a general progressive path upward, despite the periodic corrections that always take place. Well, now let's pull up TLT. TLT. And I've got the same length of time on the chart from early 2013 till today. And let me explain to you how TLT actually works. TLT is an ETF fund for the 20-year Treasury. And here's how it works. As the interest rate drops on the 20-year Treasury, TLT ticks up. As the interest rate goes up, TLT drops in value. They move inversely to one another. Well, what you'll find is that as the S&P 500 is moving up, and you can see that through the 2013 till now, TLT has moved down. Well, why is that? Well, as interest rates are moving, as more and more people are investing into the stock market, they have less reason, less incentive to invest in bonds. Well, that means the interest rate goes up on bonds to try to attract new investors because everybody's spending their money in equities or stocks, and that causes TLT to drop. Well, you'll notice here from January, from September to January, we kind of stalled out and we stayed in this one single area. And then we started a run up in January till recently we've kind of stalled up. Well, why in the world from January to June was TLT moving up in value? Why were interest rates dropping? Well, that's because there's been a large amount of turnover of people that had money tied up in equity stocks, and they've turned around and they're investing it into bonds, long-term treasuries, because they're nervous and scared because they believe, like we believe, we're at the end of that bull run, and they want to go ahead and start securing that money into some place they know they're not going to lose their shirt over. So that's why you've seen this run up. Well, from June till now, we've reached a plateau where we haven't seemed to go any higher. We're leveling out. To me, that signals a tipping point. Okay, when all the investors have securely transferred their I'm talking about big investors, these big mutual fund houses and things of that nature. When they've taken the bulk of their cash and they've tied it up into more secure investments, longer term stocks, blue chips like IBM, for example, or bonds, that's when we're going to tip over. Do you disagree with anything that I've just said, Tanner, or did you pull that up and see that yourself?
It all sounds exactly right. And you notice that the bond tapering, the program from the Fed started about the same time that it started rising as well.
Yeah.
And is just a foreshadowing of interest hikes. So that's why TLT happens to be cyclical. If I could speak today, cyclical in nature. If you notice, it goes up and then it goes down, and it tends to go in that pattern in a nice narrow range pattern, which makes it pretty predictable. And we fully expect, and Jimmy can add an idea if he disagrees. We fully expect this stock to get back into a cyclical pattern again, even though it's been broken a little bit recently over the last 2 months.
And I think it's back in it. What messed us up, I actually got into a position on, what was it, Tuesday evening, because I felt like it had turned. It showed it was at the top of its trend. It showed that it wanted to go down. It gave me a matching candle to suit, and I said, well, I've got 3 days on this, so I bought into a put position. The next day it kind of went up on me, but that didn't really bother me too much because I expected that it might. What really killed us was on Thursday, we had a Malaysian aircraft, a passenger plane with 200 and some odd people on it, I think, get shot down by Russian freedom fighters, they're calling themselves, over in the Ukraine. So that threw everything off and caused it to go even higher. I think we're going to turn down on it, and in fact, if there wasn't uncertainty in world news, I teetered on the edge of buying another put position for a rollover for this weekend. We like TLT. I think TLT is supposed to be, it should be one on your radar. Because of that cyclical nature, that up, down, repeatable, dependable pattern that it produces. It's one of the easiest ones for us to see and say, okay, it's going up, okay, it's going down. And for us short-term investors in options, I think TLT is awesome because they're cheap and affordable, and they can, on a Tuesday, they can double. So you don't have to wait till Thursday and Friday to get that doubling nature from one strike price to the next. They'll double on Monday. And correct me if I'm wrong, what are these 50-cent strike prices, Tanner?
Yeah, they're 50-cent strike prices. So doubling isn't difficult at all.
No, the TLT will double every single day, period. It's going to double. It'll get you a double every day. Picking the right time and the right direction, well, that's a little trickier. But it will double every single day, and it's got a pattern that we can see. Now, I'm going to show you something else, Tanner. Let's pull up SPY. Everybody pull up SPY, SPY. This is, of course, an ETF tied directly to the S&P 500. It's only missing anywhere from 3 stocks to 6 stocks difference between the S&P 500 and the SPDR S&P 500 ETF. It mirrors the movement pretty close. If the S&P is going up, it's going up. If it's going down, SPDR's going down with it. Well, now let me introduce you to another one. Try SLY, SLY, instead of SPY. SLY is also in the S&P, but it's the S&P 600 small cap funds. Now, let me define for you what a small cap stock is, or a small cap company. A small cap company is a company whose market capitalization is anywhere from $300 million to $2 billion. You're a small cap company if your market capitalization is anywhere from $300 million to $2 billion. So somebody like an Apple who's sitting on a few $100 billion in just net cash that they can go spend, not accounting for the rest of the company. That's just cash that they're sitting on. They're not a small cap stock. IBM, not a small cap stock. General Motors, not small cap. These are smaller companies. And as you can see, SLY does not look anything like SPY. Those are not mirroring each other at all. But let's look at SLY, and let's back out and take a larger picture. If you'll look from 2013, this big bull run we had in 2013, SLY looks a lot like SPY or the S&P 500. It mirrors it. But what the heck has happened between January and now? It's been getting beat up. These guys, there's have some up days, but it's flatlined and moving to the right. It's no longer moving up. And this is my opinion, and Tanner, I hope you have this pulled up. When SPY begins to look like SLY, when they catch up to each other, that's the tipping point. I think this is the biggest precursor that we have is these small cap stocks. People are rolling out of them. Small cap stocks tend to be high growth stocks. They tend to outperform the bigger stocks like the Apples, the General Motors, the IBMs. They tend to outperform. If you're a mutual fund manager, you'd like to tie up a large percentage of your funds into these small cap stocks because they will tend to outperform and you'll make more money with them. Well, look what's happening with them. They're rolling out of those positions. That's why TLT is doing what it's doing, but yet the overall market is continuing to move up. They're rolling out of these small cap stocks and into these 20-year, 10-year Treasury funds. That's what's going on. Do you agree with my analogy, Tanner?
Yes. Yeah, and really, if you have this up on your screen and you have the ability to screen capture it, I would screen capture it because you see how it's making a triple top?
Yeah.
I'm not talking about a short-term triple top. I'm talking about from December to now.
Yeah.
It's made tops, and it looks like it is a little bit higher, but it is moving right. And once you see the S&P 500, the overall index looking the same way or very similar to this, it is getting ready to roll over. Because what it means is that there's a long-term resistance that has held up, and once it does a triple top, it's almost as if it's given out its last breath. That's another one of the indicators, on top of the 20-year Treasury getting to 3%, that I'm looking for in order to determine when we are at least getting ready to enter a bear market.
We are definitely closer. I don't think we're there yet.
We're not there yet, no.
Yeah, there could be a world event that changes things, but as we've seen, it would have to be a significant world event because the market's pretty much shrugged off anything that world news has thrown at it here within the last 6 months.
Yep. In fact, war and the market went to the 20-day and then bounced up off of it and made a hammer. You got the Ukraine and then Soviet conflict, or I don't know what they're called now, a Russian conflict, and they have the possibility of war breaking out over there, and it moves down to its 20-day and just bounces like, you got to be kidding me. Before this time period in history, if we would have had that kind of significant world event, news event, we would have had 3 or 4 down days in a row.
Right.
That's not what happened. So.
Yeah, we turned around and had a 25-point down day on the day they shot down a Malaysian airliner, and the very next day we had a 20-point run right back up. Like, okay, that was a bad day, but let's get back to normal. It was just no big deal. So, and in full disclosure on how I'm doing with my investments, some of you guys are on the instant alert programs and some of you guys are not. In full disclosure, I'm breaking even right now. So that means for every one that I'm winning on, I'm losing on. If this was the beginning of a bull market, I'd be tearing it up. I'd be so rich right now, it wouldn't be funny. But we're at the end of a bull market, and it's really, really hard. However, I keep trying. In fact, there's 2 guys that Tanner and I have a lot of respect for that have been doing this for 30 years apiece. They have a combined market experience level of 60-plus years. And one of them, and I'm not going to give out their names. I know somebody's going to ask, but I'm not going to tell you. one of them, I believe he's an absolute genius. Do you agree with that, Tanner?
Yes, without fail.
He's got to be the smartest person that I have ever run across with this stuff. He is a genius. And he made the statement right now that if you're making money in the stock market in 2013, you're a genius. So that I'm breaking even in the stock market in 2013 right now, with the market being the way it is, I can, hey, I'm doing all right. And every time I win or every time I lose, and this is why I'm continuing to play, every time I win and every time I lose, I turn around and analyze, okay, why did I lose? Why did I win? And I try to pull nuggets of information out that will help me along the way. And so Friday, I went into I lost money on TLT. That was a world event. Hey, that just happens. There's nothing I can do about that. IBM I went into. IBM gives me a signal. We tell you guys to become intimately familiar with a handful of stocks. Watch them in their daily movement, and I've been doing that with IBM. I like that stock because it's an affordable stock. There's a lot of movement in it. Implied volatility is low, which means that I can afford that particular option. And what I've noticed is I've watched it that I can get a signal within the first 15 minutes. I can see 15 minutes worth of movement and be 75, 80% accurate on predicting what it's going to do for the rest of the day. And it gave me a particular signal that told me it was going up that day. So I bought a call position. And what did it do? It tanked like a big dog. However, it recovered. It lost $3.50 and gained $3.50 back to close where it opened. So I just called it wrong. VIX, I called right, and that's because I felt like, that while that was tragic in the world news, it probably wasn't going to affect the market too much, and they were going to bounce that back, and they did. One last thing, unless Tanner has something, I want to give everybody what I currently have as trend lines right now because it's changed a handful of times over the last 2 weeks. And so my top trend line, I don't have a bottom trend line on the S&P 500. I let the 50-day moving average be my bottom trend line. But I have a point from 624 to 716. 624 to 716 is my top trend line for the S&P 500 right now. What do you have, Tanner? Is that pretty close? Mr. Tanner.
I'm sorry, Jimmy. I had muted my own microphone due to noise, but it looks really similar to what you've got up on your screen, brother. I'm looking at the webinar on my computer. Kind of treating that top one as an anomaly. So.
See, just for everybody's sake, just what he usually does is he sticks his Bluetooth headset in his ear for his phone. He dials in on his phone and he stretches out on his bed, practically goes to sleep for these things. But
yeah, right.
All right, so Tanner, do you have something? And if you don't, we're going to turn this over to the people.
I'm just excited about what's going on because, every time that we come up with a new play, we have to make it our own. It's one of those things where each individual has a different take on it, and you have to do it based on what your emotions are and where you're at in life and all that. But I feel like we're getting better on the double day play. Like you said, you take nuggets from every single experience, whether it's good or bad, and I really think that there's going to be only a short period of time, and we're going to start seeing some 300 and 400 and 500% returns on some of those plays. Using different strategies and different techniques, like using stop outs or trailing stops and stuff like that.
And for those that follow me on the VIX, here's a nugget that I took away. On the VIX, I got a double, but I should have got 300%. And the reason why I didn't get 300% was because I decided, well, instead of being one strike price out of the money, very next strike price I cross into the money, let me go 2 because these strike prices are only 50 cents. I think we can get $1 worth of movement out of the thing today. That'll be 2 strike prices. And, hey, I can buy more options at the cheaper price. Well, on Friday, time value is eroding so quickly on you. It's just not even funny. And there is a mathematical formula for it, but it's just eroding from you. So if you don't get good movement in your direction on Friday, you're not gonna see that boost, that gain, that acceleration and increase like you would on a Thursday or a Wednesday or a Tuesday. So on Friday, on expiration day Friday, if you're in a double day play, irregardless of what the price is, do not exceed your risk budget, whatever your budget. If I can only spend $20 or $40 or $50, whatever your budget is, that means that you can't buy that option at one strike price out, then don't buy it. Move on to something else or just wait till the next weekend. Because that's what I learned. It just sit there and just hung out and waited, and it had to cross into the money before I got my double. If I'd have bought the first strike price out of the money, I'd have got a triple over. I'd have got 300% on it pretty easy because it would have went into the money pretty quickly, but I'd have paid 35 cents for it per option. But it had crossed into the money really, really quickly, and like I said, it would have tripled in value because it was already in the money. So that was a nugget that I took away from Friday's play.
Yep, and that's what we have to do. We have to learn from every single experience that we have, and go, okay, well, next time I see something like that, well, this is what I'm going to do. And the reason why is because eventually you'll get statistics on your side. Like, for example, I'll throw a little nugget out too. On Thursday, SanDisk reported earnings that were positive, and yet it gapped down. When it gapped down on negative, or gap down on positive news. They beat earnings estimates for them, and they moved down or gap down. Well, whenever I see a gap down like that in pre-market trading, I am going to buy a put position at market open. Well, why am I going to do that? Well, because Joe Investor, they haven't had the opportunity to make trades during pre-market trading. So they're going to wake up and go, holy mackerel, look at that. My position was worth, $108 or pretty close at the close yesterday, and it's going to open up at $100 or less than $100. I'm going to start to panic as Joe Investor. So they get in and they start selling it. Well, within the first 25 minutes of trading, on that day, I could have had an option go from roughly 50 cents to over $3 in 25 minutes. And now I've decided, well, next time I see a gap on positive earnings, a gap down, particularly gap down on positive earnings, I'm going to buy a put position at market open because I'm going to expect the momentum to continue in that direction. Now, would it have gone all the way to where it did? No. In fact, I would have already been out of the position by that moment in time. And the reason why is because it had moved as far as I would have anticipated it moving. However, keeping the position, I could have kept the position and used stop limits or loss limits in order to stay in that position for the rest of the day, but it would have closed my position. And the rest of the movement during the day was caused by world event, by the airliner being shot down. So, but who's going to be upset about making, a 600% return in 25 minutes, 30 minutes?
Right.
I don't know anybody who would be upset about that.
We just need to start being more consistent with making those calls when we make them. But I agree with you. When you've got great forward guidance, you beat all the way across the board on your numbers as far as earnings is concerned, and the stock gaps down anyway, yeah, then there's something else going on there. There's either other news that you don't know about that apparently some investors do, or something, and you can ride that gravy train down. I do want to briefly mention, and I'm going to give you an opportunity to talk about this, but I want you to be as clandestine with it as possible, Tanner.
Sure.
When Tanner and I first started this thing, we knew we were going to do it in phases. We wanted to learn one type of investing, but eventually we wanted to get into a final type investing. And we developed another stop, which is called the double day play. So we told you how to use options to try to make money over a 3-day, 4-day, 5-day period of time, teaching you intrinsic value and how to pick the right options as far as math is concerned. Then we turned around and we shattered some of those rules by teaching you the double day play, which can generate large amounts of capital with very little investment and a whole lot less risk. But the risk is everything. It's a lot less risk, but the risk is everything. So, but ultimately, we want to get into a position where you had very little risk, and it always made money. And my challenge to Tanner is to find a play where I can't lose. Okay, and in the end, he's done that. He's found a play that you cannot lose money on. And I'm being very general. You cannot lose money on it, so there's no risk. There's almost zero risk. And in the end, while you do have to buy your way into the positions, there's multiple positions, in the end, you've spent no money. I know that it makes it, wait a minute, you just said you had to buy into position. Yes, you buy into positions, but in the end, when it all shakes out, you've spent none of your own money to do it. So you spent none of your own money, and you have almost zero risk. Do you have the kind of reward that's present for a double-day play? No, but it's still pretty good. Now, Tanner is working on that. He's paper trading it as we speak. I can tell you that you have to have a margin account availability in your trading account, which means you have to have a minimum of, I think, $2,500 or something like that. But I'm going to tell you that you can't do this play unless you have $5,000 in your trading account. And I'm going to tell you it's not going to ever be anything that we can teach you in video form. This is going to require a week-long conference at a location where you show up and we trade this thing through the course of a week so you can wrap your brain around it because it is detailed. Give me just a couple of little nuggets of tease, Tanner, on this, and give it the name.
Like you said, it is something where you get into multiple positions, but where somebody else is actually going to ultimately pay for you to own those positions, which sounds crazy. And you're going, well, why in the world would somebody do that? Well, because they're willing to take the risk that your position isn't going to close in the money. But after you compound, and then this is the reason why we're talking about multiple positions, after you have multiple positions on one stock and they're structured a certain way, as long as the stock price closes inside that area where you have all of your positions, in between where you have your positions, you make money. So ultimately, you make money on something that somebody else paid for you to get into. So I don't know if I've given you enough of a nugget, except for the return on spending no money. If you're getting $1,200 or $1,500 off of no money spent out of your account, that's like an infinite return. So
Right, because
what we're going to
you've
do is
invested nothing, and in the end,
you've
in
invested
the end,
nothing.
if you have no capital investment and you make $1, that's an infinite return. I can't measure that. It's like
That's
somebody just
exactly
giving you
right.
$1. So,
That's exactly right. And see,
oh,
that's what we're looking at doing, except we're looking at doing it in multiples so that over time you can continue to use this system and make drastic returns on your account. And we're talking about doubling returns, that kind of returns. Doubling, we have the double day play. We're talking about risking small amounts of capital, but understanding all of it's at risk with the potential to double, okay, or more, double or more. But now we're talking about another kind of trade where you're risking none of your money ultimately in the trade, but you have the possibility of not just doubling a little bit of your account, but doubling your entire account.
your entire account.
Your entire account. Yes.
And what kind of time frame you think?
6 months roughly. So that's I could say 6 months to a year, because setting up the structure, getting those positions, it takes time to get into those positions.
Yeah, it's not something that you can just buy in all your. I'm in the position today and I'm
No,
ready. You know, it's a period
no,
of
you
time
can't
that
do
you have
that.
to build the position. You're building a position.
That's exactly right. You're building a position. It's almost like building a bridge, and it takes time to do that. So that's really what we're looking at. We're looking at showing you a system and giving you a system where you can build yourself into a position where literally, even if the trade doesn't work, you still haven't lost any money.
Yeah.
Yeah.
Yeah, you're
Which is
only at
awesome.
risk is the commissions that you would be paying to the trading company in order to be able to get into it. In fact, we're not even sure that we can make this happen on e-option. We may have to go to a secondary platform that we would recommend you go to in order to make it as simple as possible. And Tanner's going to try to make this as simple as possible and streamline it as best as he possibly can. But again, this is so complicated. It's not complicated if you have experience. It's mind-blowingly complicated if you don't have any experience. And so that's what the purpose of this phase 1 and phase 2 is to give you the basic information that you understand kind of what you're doing, and give you the opportunity to build your nest egg to the point that you can do phase 3. And if you want to do any homework on your own, I will tell you that this play, it's nobody has a name for it out there. You can't Google it. We're going to call it a boxed-in spread. You can Google that all you want to. You're not going to find jack on it, okay? This trade is a hybrid between a calendar spread, and that you can Google on Investopedia. Go to Investopedia.com, look up a calendar spread. They'll give you a great definition of that. And when you can wrap your brain around a calendar spread, then I want you to look at something called a butterfly spread. It's a hybrid between a butterfly spread, a calendar spread, and some other stuff. That's the best
That's
I can
exactly right.
describe it. So I can't wait till we get to that point. I think we'll probably be able to start teaching on that in 6 months, if I were going to put a window on it.
Yep, that's about the time frame that I'm looking at too, because it'll take me that long to paper trade it, and then also to find an investment company that their rules are such that they will allow us to do it.
Yeah.
And we're talking about e-option, or we're talking about somebody else out there. There's a whole lot of brokerage companies out there. They all have different rules. I will tell you that it's the rules, the specific rules of the brokerage company that determines whether you can do it or not. It has nothing to do with level of trading or experience or anything. It's something that's so safe that you could do it inside like an IRA account, if you had the knowledge and had the desire to do so. So that's really what we're looking at putting out there, and I can't wait until we can make the announcement that we're going to have classes on it. So.
Yeah, and I know that you say, well, is this something that you came up with? Partly. We took a lot of Tanner's taken a lot of information from multiple sources to compile this. That's why I can tell you you're not going to find this particular play advertised. Well, is anybody else actually doing this? Probably. And is it being taught somewhere? Probably. But you're going to have to pay an exorbitant amount of money to be able to. There's a guy down in Texas that he probably knows exactly how to do it, and I would guarantee you that he probably is doing it, but you'd have to spend $25,000 to go to one of his cruises in order to be able to get the information. So you're just not gonna find it. You're just not gonna find it. I'd bet money on that. So what I want to yeah. So what I want to do is open this up to you guys and take questions. I mean, did you get into a play that went well? Did you get into a play that didn't went well and you'd like our take on it? You know, would we have done that ourselves? Do you have some questions that came out of some of the class videos? Anything. And usually when I do this, you guys clam up on me. Don't do that. This is an opportunity for you to air your feelings, ask questions, share your opinions. Going once, anyone? Anyone? Bueller? Nobody. Glenn, Jerry, Dan, Paul, Bob, none of you guys have any questions? Unbelievable. Okay, so we're going to be done then. You know, I do this so you guys can actually speak, and they never take advantage of it, man. I don't know what to say. I don't know if it's because they've all got it ironed out, or because they're afraid they're going to sound stupid on air.
I don't know.
Well, in that case, then that's all I've got. We will have a surprise guest on the next conference call. I talked to Carl, and Carl said he was going to come on the next one. We'll give everybody a chance to actually meet Carl.
Awesome.
So he wasn't going to come on this one, but he wanted to come on and actually have something that he knew he was going to speak about, and he couldn't come up with any, but he guaranteed me that he'd be ready for next time. So
okay, sounds good.
Well, then, if that's all, and I'm giving everybody one more chance for somebody to chime in and say something. We'll talk about whatever you want to talk about. Then that's all I got, and we'll see you next time. Check out the website changes. There's been a couple of them. I got a question. Does anybody like the newsletter format, or do you desire changes on that? I know it doesn't come out every single day, but it comes out most days of the week. And you can just type a response in the chat window if you don't want to actually pipe in. Only Robert likes it. Everybody else has no opinion. That's awesome. Hey, all right, so then that's all we have. I thank everybody for attending. Now y'all are chiming in. That's funny. If you guys have any questions, of course, you have our number. We publish that. Just pick up the phone and give us a call. Other than that, we'll see you next time. Peace out. Bye.
All right. Bye-bye.